This is PNC Roundtable.
Hello, this is Rick DeVore, Regional President for PNC Bank, and thank you for listening to PNC Roundtable. It's on this show that we tackle some of the region's tough issues with people who make a difference.
Now here's the PNC Roundtable.
Welcome into our PNC Roundtable. I'm Paul W. Smith, along with co-host, Regional President Rick DeVore. And a very special guest we look forward to talking to every time we possibly can. Stuart G. Hoffman is the Senior Vice President, Chief Economist for the PNC Financial Services Group. You read about him in Business Week. You see him at the Economic Club of Detroit. One of the top forecasters is picked by the Wall Street Journal. He serves as the principal spokesperson on all economic issues for PNC, and we are so glad that he is here with us on WJR and the PNC Roundtable. Stu, nice to have you back.
Thank you. Very glad to be here again.
We have been dependent on you the last several years for your outlook, and you've been spot on with your outlook. Give us your take for the U.S. economy for the rest of this year and into 2016.
Well, thank you, Paul. Glad to be back, and hopefully be less inaccurate than most other economists. We're looking, it feels a little bit of deja vu all over again, because I remember when we were here last year, the economy had a really weak start to 2014. Again, I thought it was more the weather, and I think that's the case this year, although we had that West Coast dock strike that slowed things down. This year, though, we have the real positive, of course, lower oil and gasoline prices going into the year. So after what, again, looks to be a slow start to the year, we had some good job growth, but not much consumer spending. Auto sales were weak in January and February. I think as the spring comes, it doesn't quite feel like it yet, but by the calendar it's here, we're going to see a good improvement, a good rebound in the economy. Consumers are getting they're more employed, they have income, the gas prices are down. I think we'll see auto sales. Actually, I'm looking for that to be one of the key leaders for February, March auto sales to look a lot better, showing the consumer is alive and well. Some rebound in housing from a terrible winter when, hard to dig foundations when you're 4 feet under snow. And so I'm fairly positive on the economy this year, and think after a slow start, we're going to have a strong finish and create another 3 million jobs and have the unemployment rate continue to fall closer to 5% across the nation by the end of this year.
All very good news. Rick DeVore, you in agreement?
I am. I think, I think Detroit kind of mimicked what Stu was just saying nationally. First couple of months a little tepid, but seems to be picking up. Also, we've seen some activity of people, I think, of thinking that maybe they need to access the capital markets, and we've been the beneficiary of that. As you know, I've mentioned before, last year we were the victim a little bit of being on the wrong side of the ledger with M&A activity in Detroit, and I'm hoping we're on the right side of the ledger. But so far this year, we're off, Paul, to a better start than last year, and I'm feeling pretty good about it at this point.
Crane's Detroit Business the other day had a nice listing of the M&A activity, and they kind of, in a sense, give awards for people that are involved in that. You did mention, Stu, something near and dear to our hearts, especially here in Detroit, about auto sales. What is your outlook for vehicle sales?
Yeah, obviously, as you said, near and dear to your heart, but also very near and dear to the heart of the heartbeat of America and the manufacturing sector. We think the American consumer, will purchase close to 17 million new cars and trucks this year. Prices will be pretty flat. Used car prices have been falling. Maybe we'll turn around a little bit. But yeah, close to 17 million. That would be better than we did last year. Last year was about 16.7 million. But as I said, in the first 2 months of the year, we've averaged about 16.5 million. So we're definitely not running at that pace, but I'm betting the pace will pick up along with income, reasonably good financing, and better consumer confidence, translating into a nice rebound in spring and then carrying through the rest of the year, and we'll get to 17 million.
Well, in fact, and on Tuesday, March 24th's headlines, specifically in this case, the Detroit News, UAW plots strategy for contract talks. GM and Ford ranked in the top 3 spots in average hourly labor costs. FCA US, formerly Chrysler Group, was in the bottom half, largely because it has more entry-level workers than its Detroit competitors. So the estimates show labor costs slide at Ford, FCA, and increase at GM. And you should also know that as near and dear to our hearts the auto industry vehicle sales are, we're very concerned about the upcoming UAW meetings.
Yeah, I'm not sure I could add any real perspective on that. I think it'll be a good market for car manufacturers, but I'm not really sure I could comment or add anything useful to the discussions. I think in a broader context, wage growth has been pretty stale, really about 2% the last 4 years. We're seeing some pickup there, certainly some legislated hikes in minimum wage at the state level, but also we're seeing, the market, Walmart and Target and others have announced increases. So we do think there'll be a bit more wage inflation across the economy, but that's good. It would be good to see inflation, people's wages pick up a little bit from 2%, and we think it'll be closer to 2.5%, maybe not quite 3%, and that'll stay ahead of inflation, which with that help from lower energy prices, we think inflation this year is probably going to be under 1%.
Stu Hoffman is with us, Senior Vice President, Chief Economist, PNC Financial Services Group. You also mentioned something that's important to everybody, and that is the housing market and specifically a rebound. Give us a little bit more information.
Yeah, as I say, it's a tough start to the year. Existing home sales came out yesterday, so January and February were running, a little bit ahead of last year, but housing starts were quite weak. We think we're going to, again, pick up the pace, weak start, weather-related. We're looking for housing starts to be over 1 million this year. That's still well below half of what it was, at the peak, although we never should have gotten there at the peak. So we do think that we'll see more homes started. There's some supply constraints, lots and regulations and zoning laws, but mortgage rates are very, very good. Mortgage rates remain under 4%. We don't think till maybe later in the year when the Fed starts to raise rates, but into the spring and summer kind of prime home buying season. Credit availability is a little greater. Mortgage rates are very favorable. Jobs are up. So we think the housing market isn't going to get set on fire, but we think housing will continue to show a good bit of improvement over the pace of the last couple of years, continuing its slow but persistent recovery.
Ears kind of perked up, and mine were not the only ones when you talk about the Fed starting to raise interest rates. You're thinking that's happening this year?
Yeah, we do. We think it'll happen in the third quarter. Janet Yellen and her colleagues announced last week that they're no longer patient, but then she went on to say we're not impatient either, kind of a clever, we're somewhere in between, whatever that might mean. But we think sometime in the third quarter, call it late summer, the Fed will, for the first time in actually 9 years, raise interest rates, but very little, maybe 0.25%. We think that'll be beginning of a process that will take rates up over the next 2 or 3 years. But it'll be a slow rise, no big hurry, not a lot of inflation around, so no reason for the Federal Reserve to, give us a flurry of interest rates, one after the increases, one after another. Slow and deliberate, but yes, beginning in the second half of this year.
Rick, what do you think the effect will be for you on the local level at PNC?
Well, I think, first of all, it'll be interesting to see what the stock market does. That maybe a little overreaction, maybe, but
it's kind of normal, isn't it? The stock market will react as if they had no idea this would happen, and everybody's been waiting for it to happen for a while now.
Exactly, and I think once we get through that, but one of the things that I see from a banking perspective is it might get some folks maybe off the fence a little bit. Rates have been low for so long that I think it's become like the new norm. My friend to my right he had a great analogy this morning. It's like EKG of a dead person. What he means by that is it's pretty much flatlined for so long.
What do you mean by that?
What he's saying is, it's pretty much flatlined for so long. It's the new norm, if you will. And I think it might get some people thinking about, maybe selling a division, or maybe it's time to borrow, maybe put in that third line, etc. And I'm hoping that means for a more robust activity in the borrowing market. As you know, right now it's a great time to be a borrower. Rates are at historic lows, and so I'm thinking it might be the impetus to get some more movement in the economy.
Well, here's hoping that it works out in a positive way. Speaking of flat and ups and downs, gasoline prices certainly have been there. It's interesting, Stu, and I want your take on this, because I've heard arguments as to why the decline in crude oil prices is good or bad for the U.S. economy.
It's both good and bad, but I think it's a much bigger positive.
Better for us at the pump, I can tell you that.
Absolutely. There are winners and losers. There are certainly regions and there are industries and individuals who are energy producers that are hurt by this. But I clearly believe, and I think the Fed has said it as well, that for the U.S. economy overall, this is a big net benefit. It's also a benefit for Japan, China, Western Europe. The reason why is it gets back to, as you asked, gasoline prices have come down, I think, more because of a global supply glut. It's not because demand and the economy are crashing like happened in 08 and 09. So I think we have excess supply. We see that in the U.S. and around the world. So I think this decline in gasoline prices is a real positive. And the rule of thumb we've talked about before, but just to remind you, every penny that gasoline comes down saves American motorists $1.1 billion over the course of a year. Well, right now, gasoline's $1, a little over $1 less than it was this time last year. Even if it goes up a little, as it typically does into Memorial Day, Easter Memorial Day, it'll probably be $1 less than last year. And $1 times 1.1 billion American motorists over the course of this year, by our estimate, are going to spend $110 billion less at the gasoline station than they did last year. And if that doesn't help consumer spending in other areas or pay down debt, save a little more, any one of those is good for the economy short and long term.
So while salaries may be flat, that's a $110 billion increase in our wage, really, because it's $110 billion that we would have been spending otherwise. So we kind of did get a raise.
Yeah, we did. In fact, I've done the math on that. If you take the median household income's about $55,000 higher here in Detroit, but on average, the drop in gasoline saves them around $800 if it's $1 less a year. So that'd be like getting a raise of over $1,000. Pay your taxes, you'd have $800 left. That's the equivalent of 2%. So you're right. It's like the American middle-income family, middle-income household got a 2% equivalent 2% increase by gasoline prices falling. Hopefully, in addition to that, they'll actually get a 2.5% or 3% wage increase from their employers. So, it's like they're going to double that up between the drop in gasoline prices and hopefully the wage they're going to earn at their company because they're doing a good job.
It sounds, Stu Hoffman, as if you're saying the economy is pretty doggone good, and we get caught up, as we the people, in the politics of this, because we're also being told by the Republican side of the ledger now, and if it were Republican as president, the Democrats on the other side would be saying it. But, the other side always says things are horrible, tie yourself to trees, it's bad.
Well, the American consumer, the confidence on the American consumer is up. It's not back to where it was, 6 or 7 years ago. So rather than ask the politician, let's ask the people. They are feeling better about the economy. It's come off a little bit as gasoline prices rose and the weather was so lousy. But yes, I'm trying not to be political. I'm trying to look at it through the lens of an economist, an analyst, without any partisan or bias. And I think the economy still has a ways to go. We're not there yet. A 5.5% unemployment rate isn't good enough, and it still disguises a lot of underemployed and people who are not out of the workforce. So, I'm not saying that it's as good as it looks, but it's down from 10%. When it peaked in Detroit, it was 16.5%. Now it's down to 8%. A lot of cumulative progress has been made over the last 5 years, and I think more to come over the next couple of years. So we're not in the promised land yet. The economy is not where it needs to be, but it's gotten a lot better, and that's what the data tell us, and that's what consumer confidence surveys tell us.
Stu Hoffman, Senior Vice President, Chief Economist, PNC Financial Services Group, and there's something you want to add, Regional President Rick DeVore.
Well, Paul, I was going to tell you that the beauty of having, this is our 5th year in a row we've had Stu on the program. And not only do you have a feel for his candor and how he speaks about the economic issues, but it also gives us some familiarity with what happened 1, 2, 3, 4 years ago. Like Stu said, $1 a gallon more, but remember, couple of years prior, I think that's when we were about $4 a gallon, and people their hair was on fire, and they were talking about maybe $5. And Stu said, everybody take it easy here. 4 is probably the peak, and he was correct. And obviously, Detroit has much more of an affinity, or pays much more attention to gas prices than maybe anywhere in the country. But I think we forget that 240 is not a bad deal vis-a-vis 1 year ago.
Well, vis-a-vis 1 year ago here, and vis-a-vis the last several years in Europe, for example.
Right.
Yeah, speaking of Europe, I mean, the Europe economy has been weak. They did grow a little last year. When I look at, what could go wrong with my forecast or where we won't get any help, I call this a made-in-America forecast of a stronger economic growth. But it's not because we're not going to export a lot to Europe or Asia or even our North American neighbors, because those economies are weaker than ours. And I think Europe's going to grow this year, hopefully a little better than 1%. But the U.S. is well out ahead in terms of economic growth. The rest of the world, that should help places like China and Japan and Western Europe, because we buy their products. But it'll be more what our American consumer does, our housing market, state and local governments, things that are a little more domestic. And Europe is still struggling, and even Canada and Mexico, where a drop in oil is probably a net negative. More of a negative for Canada and Mexico, even if it's a net positive for the U.S. So winners and losers, and right now the U.S. looks to me to be, one of the strongest economies around, and with the best growth prospects relative to Europe, relative to other North America, relative to South America, and maybe other than India, even relative to Asia.
Will the European economy do better this year with the ECB buying sovereign bonds?
We think it will. I mean, growth last year was around 0.75%. The year before, they were in recession. We think Northern Europe will do relatively better, meaning Germany will still do the best, better than France, probably better than Italy and Greece, although in Spain, they're coming off of really out of depressions. But yes, we think the European economy will grow 1 to 1.25% this year. That is still slow. That is still below their trend. So better, partly because of what the ECB is doing, this quantitative easing, buying of government bonds, but also because the dollar or the euro has depreciated so much that's going to make European exports, whether it's to the U.S. or whether it's to China or whether it's outside of Europe, much more competitive. The euro's at $1.10. A year ago, it was $1.30. So good time to go to Europe. If you want to go to Europe on vacation, pack your bags, because this is a very good time to do it with the euro and the dollar, not quite, but approaching parity.
Don't want to. Oh, go ahead. Yes,
Paul,
go ahead.
I was just going to add that, speaking of losers in the oil, net losers, Russia would certainly fall in that category as well. And I was wondering if, Stu, if you could expand a little bit on, obviously one of the risk factors, a big one for Europe, is Russia. And I was wondering if you could maybe expand on that a little bit.
Sure. I mean, who knows what's going to happen exactly in the Ukraine. And it doesn't look, there were no shutoffs of gas during the winter between, Russia and Ukraine or others. So that was something we were worried about 6 months ago. That didn't happen. The Russian economy is clearly in a recession, although, doesn't sound like there's going to get any political change out of that. But yes, those are the things I worry about. China being much weaker than expected, Europe because of Russia or just because of their own internal weakness in their banks and their politics. Those are the things that I worry about that could be all downside risk. If for some reason there were a big rebound in oil prices because there was some hostilities in the Middle East, and the next thing we know, we are looking at gasoline back at $4 a gallon. These are the things that keep me up at night, but there's always something to worry about. The odds of those happening are, I think, pretty low, and that would include Russia having some sort of military conflict beyond the Ukraine that could really be a setback for even a slow recovery in the European economy.
Well, even here at home, watching General Motors cut its losses early and get out of Russia indicates the kinds of problems that people expect from there for some time to come.
Yes, that's a geopolitical as well as an economic decision, and if oil were to rebound, that would be great for Russia and Iran and Iraq and Venezuela and Nigeria. Not exactly our best friends around the world, but with oil at $50 or $60 a barrel, that's a real positive for us and a lot of Western Europe, and gives the U.S. a little more economic leverage beyond just the military leverage that we have in negotiations, particularly with Iran.
And slowly but surely, our manufacturers are making cars that are more fuel efficient or not as dependent on that oil. So maybe as it finally starts to go back up, we'll need less of it still.
Yeah, I mean, you've seen the share of trucks has risen, relative, and SUVs relative to cars as oil prices have come down. But trucks are more fuel efficient, will continue to be so. So the whole fleet of cars and their fuel efficiency will only get better. And with oil prices and gasoline staying down, that's even better for the American consumer and for the industry.
As Rick DeVore mentioned, 5 years now in a row you've been here and you've regaled us with your thoughts and you've been spot on. So I'm going to hope that the crystal ball works for this one. What's the outlook for the stock market, Stu?
Well, I usually prevaricate a little bit there. I mean, I'm on PNC's investment policy committee. I don't make specific forecasts on the stock market, but I can tell you this. We as a company are still fairly positive on the stock market. You think about where your investments in stocks or bonds or keep it in a money fund, and I'm not thinking about real estate or non-financial assets. We still like the stock market. It didn't do well in January, had a good February, back and forth in March. There are always going to be ups and downs. We referred earlier to the Fed funds rate hasn't changed. The Federal Reserve hasn't changed policy. It looks like an EKG. Well, when it goes up, it's going to look like the corpse might have flicked a pinky finger. And as Rick said and you said, there could be some nervous reaction to that. But I would view that as a buying opportunity. So without giving you a specific number, we think we'll be sitting here at the end of the year or a year from now when I'm back for a sixth time with the stock market is still higher, but not double digit, higher than where it is today. And probably the best rate of return between stocks, bonds, and cash will be in stocks.
So not to put words in your mouth, but from what I hear you saying, you do not harbor any of the fears that the naysayers out there have, saying it's been far too long for a major correction and the time is now.
My tagline that I've been using lately is that the people who are bearish on the stock market and on the U.S. economy are going to end up getting boiled in cheap oil this year.
Anything you want to add to that, Rick? I don't know what you could add.
I'm not sure what you can do with that one, but it might find its way in a commercial. I don't know, but no, I would agree, and I think really Stu said what we were saying earlier, and that is that you might see some short-term bumps along the road, but this massive correction thing just doesn't seem like it's in the cards this year.
Corrections are 10%. I mean, that can happen any time, and 5 to 10%, we're almost overdue for that. But a bear market, 15-20% decline would imply a much weaker economy, much weaker earnings. Would imply that we're just dead wrong on the outlook for the economy, and that of course then would trigger a severe decline in the stock market. But they don't come out of nowhere. So a correction of 5 or 10% is the kind of thing that is normal. 15 or 20% bear market is going to have to be triggered by something much more negative on the economy than we're foreseeing right now.
Remind me what happens going into the next presidential election and the stock market.
It varies. What the stock market does, it's not a consistent cycle. Sometimes after a presidential election, the stock market will go down. I think more often than not, and again, I'm not a stock market historian, so it's a little bit of recollection, but usually in the last 2 years of a president's term leading up to a new election, the stock market does well. But it's not just because of politics. It's because of what the economy is doing. And if we're right that for the next couple of years the economy is doing well, no matter who wins the election next year, not only in the White House but in the Congress, between now and then, the stock market is likely to move higher on positive economic fundamentals that will not be offset by all the political intrigue that's going to occur over the next year and a half.
Stu Hoffman, Senior Vice President, Chief Economist, PNC Financial Services Group, along with Regional President Rick DeVore, PNC Bank, our co-host. I guess if we're talking stocks, we have to talk about bonds. What's your outlook for the bond market?
Well, bonds move opposite of interest rates, and the last couple of years, practically the last 30 years, the bond market has done extraordinarily well as interest rates have fallen to rock bottom. I can talk about thinking back. I can think back. It's over 30 years ago when I began in this business. The interest rates on the prime was 21%, and that Treasury bond rate was 17%. Today it's less than 2%. But going from 17 to 2 was a major, major positive for people who own bonds. I don't think it can go much lower. And if the Fed starts raising some short-term rates, and that rate even goes from around 2% for a 10-year Treasury to 2.5%, maybe next year to 3%, that's not a big increase, but it means that bond prices are going to go down, or at least not go up much. So that's why we think the outlook for the bond market is maybe after lots of years of outperforming stocks, this will be the year that the bond market either treads water or might even lose a little money in the bond market and make it in the stock market. So we like stocks a lot better than bonds, but we're not selling bonds. We're not throwing the baby out with the bathwater. They belong in lots of portfolios, municipal bonds, corporate bonds. A lot of clients should hold on to bonds, but can be a little more defensive. Thing is, this is probably, in our opinion, not the time to be buying bonds full speed and selling stocks. We think that's the wrong way to go.
Well, that's very helpful, don't you think, Rick?
It is. And, Paul, what that translates to your listeners, especially, well, maybe not just the automotive sector, but in the last 4 weeks, we've had 3 clients access the bond market. And so what's telling me is that people are probably believing economists like Stu, thinking, okay, in Q3, if rates are going to be going up, maybe I need to get off the fence and do something. And I'm not saying that 3 customers makes a market, but it does, I think, does represent maybe a decent sampling. These are public companies I'm talking about, and obviously, and big ones at that. So
it's not just those 3. I mean, that's happening in the bond market, and a lot of companies are thinking of going to Europe because we don't have time to go into it, but interest rates are negative in Europe. A phenomenon I'm not sure I thought I'd live long enough to see, but if you put your money with the European Central Bank, they actually take of it. They charge you a negative interest rate. If you leave it with the Fed, you get 1/4%. If you leave it with the ECB or the Bank of Sweden, they charge you interest. So you give them $100, and a year later, maybe they give you back 99. It's like the big safety deposit box.
Why would anyone do that?
Well, the amounts of money, we're not talking 5 and 10s. We're talking about hundreds and hundreds of millions of dollars. So they have the safety and the security, and they have a relationship with the ECB. So it's not like they could park it under their mattress or leave it all in their bank vault. So it almost is like a big safety deposit box. It's secure, it's safe, it's insured. They can't have it stolen or lost, and they're paying a fee for the privilege of leaving it there. And it's happened in Sweden, Denmark, Germany, I think a little bit in France. It's sort of outside the normal bounds of economics to see negative interest rates, and that's, I think, a reflection of how weak the European economy is. And as you said, the European Central Bank is going to be buying those bonds. And in some ways, if they buy the bonds and they get a negative interest rate, they're not a private company. They're a reflection of the government. And if the greater good is to stimulate the economy, it may be worth paying a little negative interest from the taxpayer to try to stimulate the European economy. We're not there in the U.S. We don't foresee us getting into negative interest rates in the U.S. unless the economy takes a severe turn for the worse.
Another advantage of having you, Stu, on our PNC Roundtable with Rick DeVore is that we get your expertise as an outsider's perspective with very inside knowledge on the outlook for the Detroit metro economy.
Yes, and we've been here the last couple of years, and of course, you're going through the region, city going through bankruptcy and coming out of it. We're cautiously optimistic on this region. I said that over the last couple of years. Last year, you didn't have much job growth in the region. It was less than 1%. That 3 million national number was close to 2%, and Detroit had less than 1%. But your unemployment rate did come down. Your housing market's been doing much better. Our forecast for this year is you add about 20,000 jobs in the region. That would be about 1%. Again, still not the rate of increase at the national level. The unemployment rate probably comes down closer to 7.5%. That would still leave it above the national number, which, as I mentioned, we think will get down closer to 5%. So progress, though, in the housing market, in the region, more jobs in manufacturing, in construction, in private services. But admittedly, you're still trying to dig out of the huge job loss, almost 15% that you saw in 07, 08, 09, and even with another year or two of job growth, you won't have recovered back to that level, although the U.S. has and many other regions has, but you're closing the gap.
Good news to end on. Final word from Rick DeVore.
No, I think that is good news. I think, Paul, you're well aware, and I am as well, that what we have to do here is get we do have some vacancies on jobs, but we have an issue of the jobs not matching the skill level of some of the unemployed folks. And so I know you are well aware that the governor and a lot of folks are putting a lot of energy behind that. And that's what gives me some optimism, but that won't be maybe 2, 3, 4 years out. But we do have a lot of jobs here that are still going unfilled, and that's really the mission of a lot of us leaders in Southeast Michigan, is to work on that.
That really has been a problem, Stu. We have more jobs than we have people capable of handling those jobs.
And that's not isolated to Detroit.
Right.
I mean, in the national numbers, we have more unfilled job openings than we've seen in quite a while. So job openings are rising. Jobs have been rising more rapidly across the nation, but there are still a gaps or skills mismatch that we're
Right.
seeing at the national level, and that yet there's still people who are underemployed. So it is a little bit of an inconsistency, but it does show that some of the skills that people have coming out of college or elsewhere do not match that well with at least the requirements of the increasing number of job opens across the country. So it's not a Detroit issue. It is a Detroit issue, maybe to an even greater extent, but it's not solely a Detroit issue. It speaks to our gaps on education and training and skills. PNC certainly trying to do that. A lot of it with veterans who are coming back that do have skills that can be brought into the workforce. But a much bigger issue is the education and the training, almost more apprenticeships that we probably need to do in this country, because we have jobs and we have under and unemployed people, and we ought to be able to find a way to help them out and to help the companies out that they could be productive workers for.
Stu, always great to hear from you, whether we're reading your thoughts in the Wall Street Journal, New York Times, Barron's, or seeing you on Bloomberg TV, CNBC, or speaking at the Economic Club of Detroit. We love having you here on our PNC Roundtable, and I know, Rick, you feel the same way.
Absolutely. No, it's kind of our deal. He comes every year, and when he retires, we'll have to drag him out of retirement or something. I don't know.
Retire?
We'll
What's
work on
that
it.
mean? What's that word?
I'm not sure.
retire?
Yes, we don't know about retirement. Hopefully, a year from now, I will be back, and we'll look back and say some of the more brighter prospects that I talked about for the region and the nation and the market will come, let's say, more true than not.
Absolutely.
Stu Hoffman, Senior Vice President, Chief Economist, PNC Financial Services Group, our very special guest here on the PNC Roundtable. For President Rick DeVore, I'm Paul W. Smith. We'll talk to you in the mornings on WJR.